We'll go to Monsieur Bernier, please.
Merci et bonjour, Monsieur Carney. Je souhaite la bienvenue à notre comité. You said in a speech 2 weeks ago in Halifax, and I quote, "Monetary policy is concerned with how much money circulates in the economy and what the money is worth. The single most direct contribution that monetary policy can make to sound economic performance is to provide Canadians with confidence that their money will retain its purchasing power." You also, at the same time, spoke about the inflation target of 2%, which you called the cornerstone of the bank's monetary policy framework. I'm wondering how money can retain its purchasing power when it loses it by 2% every year. An inflation rate of 2% per year may seem small, but ultimately, when you add up 2% depreciation of the monetary unit year after year, you end up with big numbers. And I went to the Bank of Canada website, and I used the inflation calculator that you provide there to see how much value our dollar has lost over the past few years. And let's take 1990 as an example, as a reference point. It is not that long ago, but from 1990 to today, inflation in Canada adds up to 42%. This means that our dollar can now buy the equivalent of only 70 cents compared to 19 years ago. The fundamental cause of price inflation is that the money supply is continually increasing. We get price inflation because we first have monetary inflation. The more money there is, the more likely it is that overall prices will rise and that our dollar will lose its purchasing power. So I checked too also on your website, and I saw that M1, which is one definition of the monetary supply, has increased by 6 to 12% annually over the past 12 years. That's a lot more than the growth rate of our economy. This inflation eats away the income of every Canadian, and it reduces the value of their savings. Your colleague at the Federal Reserve, Mr. Bernanke, said when he appeared before a congressional committee on July 16, 2008, and I quote, that inflation is a tax, end of quote, because people are forced to pay more for goods and services they buy. So I would like to ask you two questions. The first one, do you agree with the chairman of the Federal Reserve that inflation is a tax? And my second question has to do with the 2% inflation target. Considering the very large depreciation of our currency that this implies over the years, I wonder why the target is 2%. Why not a 0% target that will allow a complete preservation of the dollar's purchasing power? I understand that this target is fixed in agreement with the Finance Department and that you cannot simply decide to change it on your own. But I would like to have your opinion as an economist. Do you think that a 0% inflation target will have more advantages, and if not, why?
And you have 2 minutes to answer.
How many? 2 minutes. You've been busy, Monsieur Bernier. A couple of things. Very rapidly, we can have a deeper discussion later. First off, as you referenced, there's a very clear accountability framework for the government, or for the Bank of Canada. It is an agreement with the Government of Canada, the 2% inflation target. It runs through 2011, and I would say that since the inception of that agreement in the early 1990s, as it's tracked, inflation has averaged in Canada exactly on that 2%. So the agreement has been fulfilled. It's important in times like this, as we were discussing earlier, where there's some disinflationary pressures. The Canadians have the confidence and they have expectations that inflation will be at that. Those expectations remain. Let me make a very important point in the current environment. The fact that Canadians can expect in the medium term that inflation will be 2% helps to bring negative real interest rates at very low interest rates at the moment. A couple of other points. Number one, you made a reference, but I absolutely agree, your calculations are correct. It's based on our calculator, so clearly it better be correct. It's a decision. This is a political economy decision. We're doing a lot of research on this, whether it would be better to have a lower target. We will come back to this committee, discuss that research at the appropriate time. What's important, though, and you used appreciation of the currency, and the one thing I want to flag on that is what is relevant for exports and competitiveness is the real effective exchange rate, which is a product of where the actual headline nominal exchange rate is and relative inflation rates in countries. And so it matters what the inflation rate is in, say, for the U.S. relative to Canada. Last point I'd like to make is on M1 growth in Canada. What's important in this time of crisis is, and always important, is the relationship between the narrow monetary aggregates and then the broader monetary aggregates. And what you're seeing in a variety of other countries is that the velocity of money has shrunk, and so the broader monetary aggregates, the credit aggregates, are not growing, even though the monetary base is growing. And the issue is to repair those linkages. In Canada, you still have a more stable relationship, and it's relevant to Mr. Mulcair's question in terms of the medium term. Last point, globally, one thing that has turned in the last month or so is that M1 growth globally is now above nominal GDP growth, which is normally a precursor of expansion. Thank you.
Thank you. Thank you very much, Mr. Carney. This session was obviously too short. You see the interest from members of all sides. We thank you very much for appearing and for answering our questions. We certainly welcome you back at any time.